Investing advice from the greatest investors. Hello and welcome back to my channel. I'm your host on this channel dedicated to bringing you the best of knowledge in finance, stocks, investment, money management and motivation. In this video post, I'll be presenting you investment advice from the greatest investors. These, as I said, are things that have helped me grow, and I believe that they will be useful to you too. I always say that as an investor and generally for healthy lifestyle choice, reading is essential. In my post Goals for Successful Life, I explain why reading should be a monthly aim to help you to succeed. It is because of my reading and research that I have been able to compile these points for you. Let's get to it. Investing is a great step to financial freedom. Many people have achieved success in riches through making the right investments. Of course, there are several investment options, but they all have the same goal of earning your money while you do nothing. In my years as an investor, I have grown through reading the lifestyles of various experts and successful investors. I can say with the confidence that I have gathered information well that has truly been useful. Let's start with the first advice: overtrading. This concept is referred to people when they're trading too much, too often. Now, investing is good, but over-investing and overtrading is not wise. Warren Buffett said, "We believe that according to the name investors and institutions that trade actively, it is like calling someone who rapidly engages in one-night stands a romantic. Nor do we think many others can achieve long-term investment success by flitting from flower to flower." What he means is that an investor will not be one who trades daily and hourly, and long-term success cannot be achieved if you regularly move from company to company. Yearly analysis of investors' behavior made by Dalio focuses on the 20 years from 1996 to 2016. The analysis shows that the SP got an 8.2 average yearly return, but the everyday investment could not get any higher than 4.67% over that same 20-year period. The reason for this low percentage is because the everyday investors hold on the equity for no more than 3 or 4 years. The summary it is, if you hold on for more than 10 years, you are more likely to make better profits. Another investors, Jim O'Shaughnessy, tweeted and said that the best things to do as an investor is not get shelled by the market's various rise and fall. He implies that although it may be dull and boring, the best things to do is nothing when investing. The conclusion here is to be patient, because as long as you don't sell your stocks, you can't lose. No matter how horrible the economy gets, don't sell. And even if you have to sell, let it be because you want to and not because of the market situation. In my post Sell How to Buy in the Present Stocks Market, you can see some of the reasons why sell could be okay. Need for returns. Warren Buffett says that fear and greed in the stock market is like a contagious disease. He says that, therefore, we never try to anticipate the arrival or departure of either disease. We attempt to be fearful when others are greedy and to be greedy when others are fearful. When looking at valuations, let's look at the SP 500 for 12 months PE ratio for the last 20 years. This chart divides the index price of the day by a 12-month earnings forecast derived from the broker forecast. That is a measurement of every dollar individuals will spend for each dollar of forecast profit when the market prices are high. Taking the dot-com bubble incident, many investors were willing to spend $23 for every $1 profit they were to make. Investors were willing to spend $8 on each dollar earned during the crisis of global finance. This shows that the market is very costly at the moment, which has given rise to people paying more for a smaller return. The rise in the global finance had resulted in equity becoming cheap. If you remember, in the summer, Warren Buffett didn't do a lot of huge purchases because funding bargains has become extremely difficult. This is why he is being very careful in the summer. Observing the trend in price in the S&P 500 in recent years is another approach to be taken. Over a century, during this period, investors observed that the trend in price was averagely steady. True above the trend and below the trend, their price differs. Without a doubt, the S&P 500 price is the upper line, and it's also true of the earnings made by the S&P 500. Furthermore, in the market terms of Buffett, it shows that investors aren't content with the income they generate from the market, which may lead to his being fearful. Think long term. As an investor, you must have an emotional forecast and perspective of the future. According to Buffett, no matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. A perfect story that shows an illustration of how Buffett was enduring was when he purchased the Coca-Cola. Having a taste of it for the first time in 1935 or 1936, he decided to make a business out of it. He bought at the rate of 6 bottles of 25 cents and then sold each in his neighborhood for 5 cents. He observed his customers and saw how attracted they were to the product. In 1988, Buffett purchased $40 million worth of shares from Coca-Cola. The shares proportion was a high one. From his major purchase of the Mac and Coca-Cola in 1988, he said the securities are expected to be held over a long haul, not be in a hurry to sell off the earned profits but remain glued to the business forever. In a summary of this, Buffett is trying to lay more emphasis on being patient when certain stocks are purchased. Holding them for a long period would yield more profits than hurriedly selling them off. What about active management? The ability to make selections of stocks that outperform the stock market is very important. High fees, being one of the things Buffett hates most, will usually make the managers make profits that are outrageous, leaving the customers out. He then hits an idea that both small and large investors should stick to low-cost index funds. He explains low fees in 2 forms. A passive investor will gain a middle result before cost because they buy the bulk of the market, while an active investor will become a part of the bulk of the market, where they also will get an average result before the cost. Whoever between these two gets the lowest cost ends up the winning party that makes great returns. The result of this is that many active managers who claim to be great pickers of stocks are in no way what they think. From Buffett's explanation, it is advisable for active investors to become passive. He further made it known that being a high fee manager that is worth the payment that is being received would only last for a short period. Let's talk about diversification. As described by Dalio as the Holy Grail, diversifying your investment reduced risk. The Holy Grail implies that you achieve a maximum return while engaging in little risk. The higher the assets purchased, the lesser the risk involved. When you diversify your investment, the probabilities of forfeit capital would be more reduced than if your investments aren't diversified. When you invest in various assets, it is impossible to know which one would yield the highest income. Diversification is a key strategy against risk and a great way to earn multiple incomes in one sitting. Let's move to be aware of forecasts. Charlie Munger, a long-term associate of Buffett, once implied that it's good to be cautious with the projections made concerning a stock because it may be wrong. Again, Jim O'Shaughnessy also shared his point about it, saying active investors generally ignore forecasts and predictions. And finally, Buffett himself said forecasts and projections are illusional, which can be confusing. Therefore, there is no use for them. This means the forecast can be inaccurate at times. These professional investors are not saying you shouldn't listen to these forecasts. They say be careful of trusting 100% in them and what they propagate. There is so much to understand when it comes to investing, but these investment gurus have given us useful points that can be a sturdy guide through the path to investment. And I'd like to say thank you for staying until the end. If you found this content useful, then by all means let me know in the comment section down below. Don't forget to press the like button and share also. If you want content like this regularly, subscribe and you will be getting great content every week. So thank you for being with me. Until next time, stay green and motivated.